Welcome to the Continuing Education module, Understanding Disability Insurance, Some Insights for Wellness Professionals. Our agenda for this module includes some basic definitions and some of the history of disability insurance, general patterns of disability insurance use and coverage, suggestions for measurement related to wellness interventions, some targeting of disability insurance with programming, and a summary of key points. Our definition to start with is that disability insurance is often called DI or disability income insurance, is a form of insurance that insures the beneficiary's earned income against the risk that a disability will make working and therefore earning impossible. It includes paid sick leave, short-term disability benefits, and long-term disability benefits. And usually these are 4 or 3 of the major components that we think about when we talk about integrated disability management. The general patterns of disability insurance include highly variable coverage patterns depending on the type of industry and the age of the employer involved. About 60% of disabling injuries occur outside of work. So our context of the non-work related is what our focus is in disability insurance. It is countered with workers' compensation, experience, and claims. Disability insurance usually provides 50 to 70% of your base salary or wage, but it is oftentimes tax-free. So the issue of a tax-free benefit at 50 to 70% of your base salary or wage pretty much provides you with full income replacement. Where coverage is in place, the typical pattern is 8 to 12 sick leave days. That's what's called the discretionary or designated sick leave, and that's a must-use first kind of provision in most employer situations. And then from 30 to 180 days of short-term disability coverage. Sometimes those short-term disability policies are limited to 90 days, but you can also find many of them in the 180 day range as well. And from 180 days to 2 years is usually our long-term disability. Some long-term disability policies under disability insurance sometimes go for longer periods of time, up to 5 years. But the idea that a 2-year period is long enough for someone with a permanent disability to in fact apply for Social Security and supplemental security income to provide the amount of compensation and income that they need to sustain their livelihood or their lifestyle. Usually, the coverage is when it's in place you're expected to receive Social Security disability status after that 2-year period. Some of the long-term policies and long-term disability policies cover up to 10 years, so they can go out to that period of time. Typically, it's used by less than 1% of employees. So it's a very rare occurrence to have someone trigger a disability insurance claim or a disability insurance filing that is covered under one of these short-term disability or long-term disability policies. More details on disability insurance is that there is a death caused by a motor vehicle crash every 12 minutes. There is a disabling injury every 13 seconds. That's according to the National Safety Council Injury Facts 2015 edition. 51.2 million Americans have some level of disability, and that is under the Americans for Disability Act, the ADA, and they represent 18% of the U.S. population. And those with severe disabilities are usually not in a working situation, but maybe in a home setting, adult home, and or supervised care facilities. In 2017, or in 27 rather, 12.8% of people ages 21 through 64 surveyed have a disabling injury, and that's the U.S. Census Bureau and what's called the American Community Survey. published in 2015. Almost 3 in 10 workers entering the workforce today will become disabled before retirement. So that's about 30% of the workers newly entering the workplace. And that's according to the Social Security Administration and their 2013 fact sheet. At age 40, the average worker faces only a 14% chance of dying before the age of 65, but a 21% chance of being disabled for 90 days or more. And that is the Insurance Information Institute, published in November of 2014. A 20-year-old worker has a 30% chance of becoming disabled before retirement age and only a 17% chance of dying before age 65. That's according to the Social Security, another set of population-based information, and that's the Disability Benefits publication from the National Vital Statistics Report for 2010. So this just shows you some of the various sources that we use to give us a sense of what the occurrence of disability is in our U.S. population. And the number of disabled workers in America has risen by 35% since 2000, and that's according to the Social Security Administration, a recent issuance. Now, worker health-related costs 2015, are basically shown here. It's a combination of the Bureau of Labor Statistics Employment Cost of Compensation Index data. That's for all the items on the left-hand side of the pie chart. And then the right-hand presenteeism cost comes from an extrapolation of the Collins article that looked at Dow Chemical Corporation and 56,000 of its employees, and then evaluated the effects of chronic health conditions on performance, absence, and total economic impact, using presenteeism as their prime variable for looking at economic impact of chronic health conditions. So that amount comes up to about $37,000 per year, and you'll notice that the disability costs are about $1,400, and I believe $1,444 is the actual amount coming from the BLS studies. And we also have to compare that with approximately $300 per year on wellness programming costs, which is less than 1% of what is totally being spent on an average across the U.S. workforce. Now, the national pattern of disability coverage coming from the Bureau of Labor Statistics and the issuance that you see in the bottom there cited has these types of numbers attached to it. So you can see that all workers have the percentage of all workers that have access to life insurance. About 59% have access, and according to these survey results, 56% actually participate. So about 3% do not participate. In short-term disability, only 39% of all workers in private industry have access, and about 38% of those actually participate. So we have a little more than a third having access, but then a third of those actually participate in the short-term disability. And from a purely technical vantage point, short-term disability insurance is really an important benefit for virtually all working Americans based on what you saw previously in terms of the percentages of potential vulnerability or applicability of some of these kinds of losses. And then long-term disability, again, about a third of the population having access, so you can see a little bit higher access among short-term disability, about 6 percentage points, but the participation is a little lower than what you see in short-term disability. So fewer people have access to it and fewer people take long-term disability. Then you can also see some of the numbers, which we won't go through all of them, but it covers full and part-time status workers, wage category, the lowest 25% and highest 25%, establishment by size, so you'll generally see a pattern that the larger the establishment you work for, the more likely it is that they will have these kinds of benefits offered to employees. We also have the numbers for all workers at state and local government level, and then their part-time, full-time differential, and their wage categorization differential. So again, you can see some indications from this survey data published in 2010 by the Bureau of Labor Statistics. Now, disability insurance features, and this again comes from that same 2010 publication. If we look at life insurance, short-term and long-term disability insurance benefits, some selected provisions for a comparison between private industry and state and local government workers. Again, the March 2010 is the time period for this particular issuance and report. We have the method of benefit payment comparison between private industry and state and local government. And what you see here is the difference in percentage with a fixed multiple of annual earnings being one of the most typical ways that the method of benefit payment is arrived at. And then flat dollar amounts being the secondary, and then the other variable amounts of annual earnings and or dollar amounts being also relatively low occurrence. And the flat dollar median amount would be these levels of coverage. So it's offering up to this level of benefit related to the policy. And then the next issue is the fixed multiple of annual earnings benefits formulas. So it gives you an idea of how those policies in various areas look at the issue of multiples of annual earnings. You have a comparison between private and public sectors. Method of benefit payment, fixed percent of annual earnings. Method of benefit payment under the state for long-term disability provisions. These two answers are for short-term. These two answers are for long-term. So it gives you a little more breakdown in terms of the types of patterns that we see around disability insurance. This next data comes from our same survey, the 2010 survey, and it's a contribution pattern. And here we're looking at private industry in blue, state and local government in red. And you can see life insurance has a employee contribution requirement at a higher level than does the private industry, whereas it's reversed in the short-term disability and then goes back to the same pattern as life insurance under long-term disability. So it just provides you with a little bit of a sense of how these benefits compare and what the patterns are on a national. The top 10 causes for disability are these. So if we see the 19% at the highest percentage of the top 10, these account for a total of about 70% of all of the causes for disability payments. And this is both short-term and long-term together. So we see the rank, the arthritic rheumatism being one of the highest occurring cases, then back or spine problems, and that gets back into our back pain as being one of the big 8 that we generally want to focus on when we're looking at the issues of how people are taking care of their back and spine. Heart trouble being the next most frequent, the third ranked. Lung and respiratory problems, and much of this is secondary to chronic tobacco use and smoking. And mental or emotional problems, diabetes being number 6, deafness or hearing problem the 7th, stiffness or deformity of limbs and extremities 8th, blindness or vision problems and vision acuity 9, and stroke down at number 10. So again, these 10 causes of disability account for 70%, and that's a Pareto kind of phenomena, where these 10 account for 70% of all of the disability in the U.S. This is again reported by the Centers for Disease Control and the Mortality Morbidity Weekly Reporter. That's the major publication for public health that the Centers for Disease Control puts out on a weekly basis. Now, the major cost management pathways for disability insurance that we can think about are, first of all, building management commitment and understanding about the benefit and about the protection that it provides, implementing a strong safety and injury prevention program, and that includes worksite, home, vehicular, and recreational safety prevention. And besides the required work-related, which is oftentimes under OSHA or NIOSH, the National Institutes of Occupational Safety and Health, and or the occupational safety and health activities that are conducted by state government, which are requirements for many of the employers that have significant risk of injury and illness for workers, and the ability for us to look at injury prevention strategies that affect home and home injury prevention, vehicular, which is really things like defensive driving or limiting your distracted driving so that you in fact reduce your risk of automobile injury and accidents and injuries which result from those, and mortality, premature mortality that results from those as well. And then R is recreation. So that gets at the issues of what we do in terms of maintaining our safety and injury prevention kind of status when we are recreating. So those are some of the ways in which we have pathways that help us manage this particular issue, the disability insurance issue. The third strategy is working with the insurance company that provides coverage for these areas and insurance adjusters and consultants. So that's helping us identify where some of the risks are and reducing those risks. The next strategy is implementing an effective return to work and or transitional duty program. So that's when we provide some options for people that may not be up to fully functioning in terms of their job role, but can in fact provide some return to work opportunity where they can be in a transitional duty status. Recognizing and eliminating fraud and abuse of these benefits, which there is a specific component that we find on virtually any analysis. Understanding the relationships between sick leave, short-term disability, long-term disability, and Family Medical Leave Act, which is our federal legislation that allows people to take time off uncompensated or non-compensated for family-related medical problems. Improving communication with employees and training supervisors would be another core strategy. And finally, reducing some of the health risks in the work site and workforce and spousal populations that reduce the probability of them becoming high risk and then becoming susceptible to one of a number of chronic conditions. So those are some of the major pathways that we think about for helping reduce our frequency, incidence, prevalence, and severity of disability events not tied to a work-related cause, which would be under workers' compensation, but essentially requiring or having people not be able to perform their work functions. Now, the costs of disability insurance, the visible costs, are going to include any premium cost for an STD or LTD policy, the claims costs if we are self-insured for those, and our hidden costs are going to be the cost of other employees being asked to fill in when we in fact are not able to work, the decreased overall productivity of the affected employees affected by the absence of that individual that is on disability, any temporary help costs that are incurred, any possible loss of business due to the absence of an employee, and possibly dissatisfied customers. So these are going to constitute the major visible costs and hidden costs associated with disability insurance. And finally, the problems with employee morale. So those are issues that will be part of the hidden costs for disability insurance and disability events in a working population. Now, the possible disability insurance analytics are two different types. The first one is, what are the major trends affecting disability insurance costs? And those include total disability insurance costs, STD and LTD, for each of the last 5 years, and then estimated for next year. Another way of looking at this is the per capita disability insurance costs for each of the last 5 years and estimated for next year, and that's per full-time equivalent. Another metric or analytic that we could potentially use is an average annual cost per reported case for each of the last 5 years. So that gives us some trend information on what those cases are in fact costing. And the average annual number of reported cases per 1,000 FTEs. You may use 100 FTEs, but probably would be better to use 1,000 FTEs as your numerator or denominator for each of the last 5 years. So what that does is it shows you more of the pure occurrence associated with a set number of employees. And your percent of claims and claims cost by major cause and category for the last 5 years. So that's revealing to you the pattern of injuries and or illnesses that are keeping people from being able to work. The second area where our analytics are useful is in what disability insurance data should be routinely tracked in terms of just tracking your experience with disability. And our suggestion is the average disability insurance cost for individually for STD and LTD per full-time equivalent or full-time equivalent employee by geographic location and percent of total corporate-wide claims cost for each year. So you're looking at the pattern, distribution, and magnitude. It's helping you identify whether you have some geographic locations that really need more attention in terms of disability management. The annual incidence rates of STD, short-term disability, and long-term disability, LTD cases per 1,000 employees per year, and the average claims cost by category of major cause for each year. And that's a more useful type of analytic when you have very large numbers of employees. Because this is a fairly rare phenomena, it doesn't necessarily help us to see some of this information if in fact our case rates are so low that there's not much we can really do about the patterns that we see. This type of data is more useful when we have sufficient numbers of people experiencing disability, more the actuarially credible size populations, and then being able to analyze the patterns and look at interventions and how they affect and change the patterns. Now, estimating the value of disability insurance savings can be done in the following way. But first we're going to look at some strategic issues, then we're going to look at some methodological issues, then we're going to show you an example. So we start with the strategic level, and we want to know, are we insured or self-insured for those disability insurance benefits? And that really depends a lot on the size of our workforce. We need to be very large, usually, to self-insure our disability. The visible versus hidden costs. So are we trying to capture more than just the direct visible cost by looking at some of the potentially hidden costs? What's the claims patterns that we are looking at? Are there nodes in our organization that have unusually high amounts of claims and frequency of claims? Are we dealing with closed and or open cases altogether? So that's the issue of, is the case closed? And are they back at work, or in fact are they still off work and carrying through into the next calendar year? Time period involved. So that's the issue of how long are we looking at in terms of the pattern of our disability claims. The validity of claims data. Do we have good, clear, mistake-free, error-free types of claims data to look at? And finally, has there been any major change in vendors, that the methods used by one vendor might be significantly different from another, and affect the occurrence, the severity of the cases, and or is there anything that's pushing our case rates, our case incidence rates? So those are some of the strategic issues that are associated with the estimating the value of disability insurance savings when we in fact do a wellness-oriented program. There are a number of studies, by the way, that have created and shown us correlations between risk factors in the population, health risk factors, and increased levels of disability insurance use and severity of cases. So we know that many of the things that we focus on in wellness do in fact have an impact on disability experience, and that gives us the opportunity to use wellness as one of our preventive strategies in terms of these types of cases and situations. The other part of estimating the value of disability insurance savings is the methodological issues. And there, are we looking at the actual or average wage and salary continuation cost? So workers' comp provides a continuation of earnings, and disability insurance also, its purpose is to provide that continuation of earnings or wage and salary. So are you using the actual individual's wage and salary, or are you taking an average and then measuring your frequency severity against those average costs? Ceteris paribus is the economic axiom that is everything else equal? We haven't, in terms of being able to look at the attribution between the wellness program and the effects on disability insurance costs, is there anything else operating that would upset the attribution between observed effect of a wellness program versus lower rates of either frequency and or severity of cases? And the econometric assumptions are another area of question. And that's the issue of, in our methodology, what types of economic or econometric assumptions are we making in our analysis that can then be looked at by others and understood in terms of their reasonableness. We also have the issue of, are we looking only at participants, or are we including a look at non-participants and participants and doing a comparison between those two populations? And that means we need to be able to sift out our claims under disability by whether there's the status of the individual as a participant in our wellness program or as a non-participant. And finally, are we using any form of discounting or constant dollars in our analysis? Are we looking at multiple year data and attempting to actually account for the difference in the purchasing power of those dollars? And we usually accomplish that through being able to use some econometric rules around discounting for constant dollar analysis. And the next area is example of estimating the savings associated with these. And the case details, we have 2,000 employees, 1,000 program participants in the wellness program. Our disability insurance cost includes both the STD and LTD costs of coverage. The average annual disability insurance cost per full-time equivalent for participants and non-participants pre and post, before the program and after the program. And our non-participants, the cost was $214 greater per person per year in those disability costs, whereas participants in the wellness program were $257 less. So there's a spread of approximately $500 between the non-participant and participant as it grows during the year or 2 years of program operation. We assume the effect is consistent across subpopulations, so that we basically say that our phenomena is measurable and trackable across major subpopulations, that we can assume some wellness program costs, in this case $100 per employee per year as our wellness program budget. And finally, no other plausible explanation for observed changes in our disability insurance annual costs. The calculations for this example of estimating savings is we have 1,000 non-participants. The amount of being spent on that group is $214,000 of additional disability insurance claims cost. We have the 1,000 participants with a minus $257,000 of expense for disability. And if participants would have had the same experience as non-participants, the total cost would have been greater by $471,000. And instead, the actual cost was $471,000 less, or $471 of savings per participant for the year. The benefit cost ratio is then $471 divided by that $100 per person, or $4.71 for each dollar of cost. That turns into an ROI of 471%. So the issues here are being able to work on the per employee cost, to look at what happens pre and post, to examine that difference over time, and then to equate it back to what the proportion of that savings is to the actual program cost involved. Now, how wellness programming can affect disability costs, particularly through program targeting, is through risk reduction. So we know from the literature around the epidemiology of worker health and worker health costs that risk reduction does in fact reduce cost and disability. We also have injury prevention efforts, and those may be in the work site, they may be in the home, vehicular, and recreational context. So those are some of the areas where we can do injury prevention. We also have increased medical self-care skills. So if our wellness program is actually helping people make wiser choices about how to handle the symptoms that we commonly encounter, and particularly the symptoms associated with the illness or injury that may be the causal issue, the prime causal reason for their taking disability. And we also have improved consumer health skills. So we have some issues related to compliance with medical advice, asking of questions, being able to perform any kind of self-tests and or self-tracking of behavior change around health. So those are improved health consumer skills. We also usually have some improved self-efficacy or self-agency, and that's the extent to which the individual is confident in making decisions about their health and well-being. And finally, we also may have some direct effects coming from things like defensive driving courses, and particularly distracted driving, reducing the amount of distracted driving that one is doing by not using a hands-free device or attempting to text while you're driving, some of those kinds of activities. So these are, again, some of the ways that our wellness programs can affect disability insurance costs. Now, a summary of key points. Disability costs are typically the second smallest health-related cost for most organizations. So it's not a real large cost, but it is definitely a very discrete cost, usually known by your financial management people in most organizations. Depending on the industry characteristics, risk can be 2.5 times the average experience. So the range of average experience to risk can go up to as high as 2.5 times that average level of claims experience under a disability insurance plan. There are a number of pathways for controlling disability costs. Not all workers have STD and LTD coverage. We saw some of the coverage characteristics and percentages earlier, but they should have it in terms of coverage. It's vital to be able to protect our employees against the financial losses that they oftentimes incur when they are not able to work for an extended period of time. Health risk increase disability costs significantly. So we have a number of epidemiologic studies that show if you have a very high overall wellness score from your HRA, signifying you have several risk factors, that your disability costs would be very high. Multiple health risk increase disability costs in a similar way to health plan cost, sick leave, and workers' comp. So the same kinds of patterns are evolve and can be found in that situation. There is minimal standardization in disability management data. So this is a field that does not have a lot of standardization of how things are counted and what denominators and numerators are used to help employers understand the nature of the risk that they're dealing with. There are disability analytics and metrics that should be routinely tracked. We went over a number of those that can show us changes going on within our disability experience, but also show us some of the common elements of disability. Disability cases have adverse effects on the productivity of an organization. So whenever we are experiencing disability cases, that's got a ripple effect on the organization in terms of absent workers and the impact that that has on overall work productivity and the work experience of the co-workers who are not injured or not absent from work. And worksite wellness has many different interventions that can help to reduce disability costs. So these are a summary of the key points from this particular module. Now let's look at some key questions on this issue. What factors are likely to make this issue, the disability insurance costs, more important over time? And some of the issues are the aging of the workforce, the provision that people have around their level of fitness and around their physical activity levels, and whether they in fact are fit and are capable to do the work that they're required to do. Also the issue of how the various other benefits provide support and make up for some of the financial costs involved in that individual's health and well-being. In addition, I think it's also the issue that has to do with what the pattern of behavior is in areas related to seasonal fluctuations in activity levels, as well as the issues of risk involved in that particular place: ice, snow, heavy weather, substantial weather, distracted driving, all of those kinds of factors. So those things are likely to increase some of the needs and some of the risk issues in this particular area of benefits. Next question is, who is likely to have disability information in most organizations? And usually it's within the HR area for the programmatic type information and in the financial management area for the cost-related information. So those are the places you're generally going to go to find out things like what kinds of reasons are people experiencing related to their disability activity or disability occurrence. And the issue of cost also has to do with, are we only able to look at direct cost, and are there any assumptions which are reasonable for us to make as econometric assumptions about the hidden costs that we mentioned briefly in the module. The third question is, where do disability-related costs show up for most organizations? And I believe that they show up in the IRS filings, the 550, the 5500 report. They also show up in various parts of the financial statements of the organization. So they are usually attributed or rolled into benefit categories, compensation categories, and can be found in kind of different places depending on the structure of the accounting that's done by the organization. It's also different in a public sector setting versus a private sector setting. So those are where those issues are going to occur. In general, disability-related costs, the hidden ones, are going to be harder for us to acknowledge and determine, whereas the more direct ones are a little bit easier for us to get a handle on. So these are some of the answers to these key questions. Now that you completed this module, go ahead and take the quiz.